Hi, welcome to our video series here today with Burkholder Wealth Management. My name is Jordan Bradford and I'm here today with Eric Burkholder. And what we want to do in this video is do a 2022 market recap and give you some of our thoughts on what happened and maybe where we go from here in 2023. So
an eventful year in 2022.
To say the least, yes.
So Jordan, why don't you kick us off and give us some annual performance numbers?
Yeah, so in 2022, we saw a bit of a wide variety of performance numbers from the three major market indexes that most people track, which is the Dow, the S&P 500, and the NASDAQ. And looking back at 2022, the Dow is the best performer. I think there's a lot of reasons for that, and we'll touch on that in this video. But the Dow is only down 9.73%. Now, I say only down.
Right.
I don't think many people are too happy being down nearly 10%, but we're going to give some context to that in this video. When you compare that to the S&P 500, a little broader index to look at, maybe a better index than the Dow just on the overall health of the U.S. market.
Right.
S&P was down almost 20%, down 19.9% in 2022, which is the seventh worst year in the S&P 500's history. So it's never good to be on a list of the worst of anything, certainly not when it comes to performance and not when you're talking about your long-term retirement plans and goals and things like that. And then to cap it off, we have the NASDAQ, which has been doing great up until 2022, the last handful of years. NASDAQ was down a whopping 33.2% in 2022.
Yeah, that hurts.
Yeah, that's a big drop, and we'll talk a little bit about that one as well, and what you need to recover from that. But I think that when we're looking at the overall performance of the markets, we're seeing a big discrepancy really from value to growth. Mm-hmm. And I think that's where you see that big difference there. And even in Q4, there was some interesting, numbers, right?
Yeah, and we did talk about in one of the previous video updates, about especially post-election, often the fourth quarter tends to rebound, and we certainly saw that. It couldn't quite get us into positive territory for any index, but the Dow Jones was up 15% in the fourth quarter this year, S&P about 7%, and NASDAQ actually was down still in the fourth quarter, but we saw a really strong rebound, and the story of value outperforming, continued even into the fourth quarter on the strong upside. And so we'll dig into that a little bit more in a bit, but it was a good year for value for sure. And I think one takeaway, and it's easier for people, unfortunately, to experience this, is often when you have indexes or investments that tend to be at the top on any given year, like the NASDAQ and tech and growth, that volatility on the upside often mirrors on the downside. And so one thing when we look at very long time frames is we want to squeeze those in. If you're hitting the number one performer on a year, there's a very good chance you're going to be the bottom performer on another year. So the whole point of compounding is to try to decrease those extremes on both sides, and ultimately leads to a higher rate of return. Yeah,
there's a good baseball analogy out there that rather than swinging for the fences, when you do that, you get home runs or strikeouts.
Yeah.
Instead, what we want to do with our investments is we want to hit lots of singles and doubles. Be more consistent, have a higher batting average, get on base more, give yourself an opportunity to succeed in the markets. And to do that, you got to be on base, right?
Exactly.
Can't be striking out. And I think that's the story of the NASDAQ in the last 5 years. Is it's been some great years for people, but now in 2022, if you were really NASDAQ heavy, you lost a third of your portfolio value in a single calendar year, which could have wiped out maybe a few years worth of positive returns. So, that's obviously not anything anyone wants to have happen to their portfolio.
Right. And we have been already talking in client meetings about what it takes to get that back. And it is not 33%.
Right.
And I think, Jordan, you know some of those specifics. If you're down 33%, what do you need to get back to even?
Yeah, well, actually, I'll start with the Dow because all these numbers are really interesting. So if you're invested solely in the Dow Jones, you'd be down 9.73%, which will round that up to 10. or down to 10, I guess in this case, you need an 11% return to recover that 10% loss. So you got to make up more on the upside because now you're working from a smaller number.
Right. But not a lot. I mean,
that's pretty reasonable. If you're down 10 and need 11, I think most people would be very happy knowing that that's not that big of a spread.
Right.
We can handle that. You get to the S&P 500 down nearly 20, now you need a 25% return to get back to even. So you see that spread widening a little bit. The biggest problem is that as that downside number gets bigger, the discrepancy on what you need to recover gets wider faster. So it's like an ever expanding number there. So the NASDAQ being down 33% means you need a 50% return just to get back to even. And if you think about, simple mathematics, because you may be wondering, how is that possible, Jordan, right? How could you need 50%? Well, let's say you had $100 and you lost 1/3 of the value. Now you have roughly $66, $67. The problem is that for you to get that $33 back, you're now starting at around 66, so you need 50%. That's half of what you already have. So as you can see, the further you slide down, the harder it is to slide back up, or climb back up, if you will.
And a takeaway from that also is, it's not we'll call it a 20% difference between outperformance of the Dow versus the NASDAQ. It's more like a 50% outperformance, or sorry, 30% outperformance.
Yeah, exactly.
When you take into what it will take to get back up.
Right.
And so, again, that's why we always talk about managing the downside on the risk as well.
Yeah, we don't want to be so risk averse that we can't accept any downside, but we want to look at a year like 2022, and I think all of us, if we had to pick an index to be tracking closest to, we'd want the Dow, right? We'd want to only be down 9.73 versus nearly 20 or over 33%. So it just goes to show that staying diversified and having a good value tilt, which we'll talk about in this video, is really important.
Right. Exactly.
So I think maybe what we should get into next is some news that happened in 2022, and maybe just kind of go over some ideas on maybe why was the market down so much, and why was this one of the worst years in market performance history, at least for the S&P.
Yes, and there were plenty. There was no shortage of reasons why the market was down this year. We had a technical recession to start off the year. Some debate whether it was a real recession or not. I will stick with the formal definition we've always used and say we did have a very small recession to start. Right off the bat, in February we had Russia invade Ukraine. We had inflation start spiraling out of control. It hit 9.1% on an annualized basis in June, which we haven't seen rates like that since the 80s. And then corresponding with that was the Fed raising interest rates to try to combat inflation. We went from a target of effectively 0 to 25 basis points on the Fed funds rate to over close to 4.5 now at this point. And we had 7 interest rate increases throughout the year. And so a lot of headwinds that the market faced this year. Also an election year, which typically just adds to the uncertainty. And so you had a lot of factors working against the market. And, we always talk about, we know that we will face things like this. And it's important to be prepared for them.
Right.
We cannot predict when these will hit. I mean, people have been saying interest rates will raise my entire career, and it only now just happened. Right. So there'll be a lot of people who say, "Oh, I knew this was going to happen." Well, most of those people have been saying it for 10 years. Eventually, you will be right. Timing is what's difficult.
Yeah, if you say it's going to rain every day, eventually you're going to be right.
Right. Exactly.
But it doesn't mean you should be a meteorologist.
Right. Yeah, and it's I think it would have been very difficult to predict a lot of, certainly Russia invading Ukraine, things like that. And so that was the backdrop of what we had this year. And, some things are showing signs of improvement. So inflation, I think in December we saw it's now an annualized rate about 7.
Improvement.
And for going in the right direction.
Yes.
It seems like the Fed is talking of slowing or being about where they are comfortable with on interest rates. A lot of specifically the underlying inflation numbers, shipping costs have come down, construction costs are coming down. The labor market still looks robust, and so we're starting to see some positive signs in there. We did talk about in our previous video, as we get more certainty around elections and things like that, markets tend to recover, and so we've started to see that. And so, we get the question of what's to come in 2023.
Yeah,
I wish I knew, but we don't know. And but there are positive signs in the economy, in the markets, and I would say just what we do here is we invest based on statistics and what we do know. And so, if you look at the last 15 recessions, and you pick the day the recession started, 2 years from that point, 11 out of those 15 periods, the markets were positive, with an average rate of return of about 8%. Right.
Yeah.
And so,
which is really in line with just the historical average performance in the market.
About 3/4 of the time, the market's up, and the market tends to do about 10. That's a little bit lower, but yes, almost just a normal market going forward.
Right.
And that's on the day a recession starts. So I would say, and we preach this to all of our clients, if you're investing, your time frame certainly should be longer than 2 years. And so if you say, hey, my time frame is at least 2 years, even if we have another recession, I would say typically the market's going to be positive 2 years from now.
Right.
And it's much more difficult to try to get in and out. That always ends up burning someone at some point. And so, we build portfolios to withstand recessions, not to try to predict and get in and out. And so that's the whole point of basing your investment philosophy on concrete, foundational, academic, and scientific methodologies.
Yeah. Well, I think that's a great segue to, the next topic I want to cover, and the last one I want to cover really with us in this video is just the power of diversification in a year like 2022. So I think, maybe the first thing that would be worth discussing is, and we've done some videos on this, but it's the premiums that we're looking for in a portfolio to tilt towards.
Right.
And so if you've seen some of our other videos, you know that those three main premiums are value, size, and profitability. And without getting into too much detail on each one of them, the value premium is that, we believe that smaller companies, value companies historically outperform growth companies. And we have a specific video on that, so if you have more questions, I'd highly encourage you to watch that one. And then the size premium is that small generally beats large over the long haul. And then profitability, that one's a real easy one. Companies that are profitable tend to beat companies that are not profitable.
Right.
Makes a lot of sense. But in 2022, all three of those premiums were positive in comparison to the broader market. And that's just the story of being diversified and using data and statistics to help us make educated decisions. We're not trying to predict where the market's going. All we're trying to do is put as many chips in your favor as possible so that when the market reacts the way we expect, we can take advantage of that. When it acts the way we don't expect, we can limit some of that downside.
Exactly. Right. And, another point on the diversification point, and we didn't necessarily touch on this on the market return, but bonds had, many bond indexes had their worst year ever.
Yeah.
The ag, I think, was down 13% this year, and so even when we talk about equities versus fixed income, we've got to have balance there as well. Our equity portfolios, because they are heavily value oriented and focused on these other premiums you just mentioned, we're down 9 to 10%, given the range there. That actually outperformed bonds this year. And so that is very unlikely. I'm not saying you should expect that, but it really speaks to, again, the idea of diversification. Even if you are going more conservative, you should not have loaded up on bonds, and especially going forward with inflation, we've got to have some balance there.
Yeah, imagine if you were an investor in December of 2021 and someone told you that the market, the S&P, was going to be down 20%. I think the average investor, without any other knowledge of what else was going to happen in 2022, probably would have loaded up on fixed income and bonds and would have seen a pretty lackluster year in performance. And now you'd be sitting in a position where your idea of the more secure, safer investment, not that it's necessarily safe comparatively, but it's safer-ish. Investment is down 13% potentially.
Right.
So that's a tough pill to swallow, especially if you were making that move and anticipating markets being down.
Right.
So it's a good idea to just continue to stay diversified. I don't think there's not a lot of good examples where I would say someone should be all fixed income or even all equities, as long as if you're even remotely close to retirement. I think that there's a really good argument for having a mix of both bonds and equities in your portfolio.
Right, exactly. And I think that's a great point you made, Jordan, that you could even be right about something and from an investment standpoint still get it wrong.
Yep.
Inflation, again, if we were to tell someone at the beginning of 2021 annualized inflation is going to hit 9% this year, there's a good chance they might have loaded up on gold and cryptocurrencies, which a lot people believe were going to be a really strong inflation hedge. That could not have been more wrong if anyone did that. And again, that's just, there are so many factors affecting the market and how it behaves. You could be exactly right on one front and get it totally wrong on the other, and it's just very difficult. We didn't touch on crypto. We maybe will have another video on that, but I'm sure most people out there are familiar. It was not a good year at all for cryptocurrencies. Or gold, really, compared to what we would have expected to do in an inflationary environment. So, I think this is a great year to look at your portfolio and say, am I diversified enough?
Right.
Because all those things we just discussed, diversification is what benefits you in the long term. You're never going to be the number one performer in a given year, but this is a perfect year of it working as it should. Really, really controlling that downside, and even having some things in the portfolio that were positive. We use some things that would be considered alternative investments. When we say that, all that means is things that do not behave like bonds or equities. For us, we do have what we consider inflation hedge as an exposure to some commodities, oil and natural gas companies. Did phenomenally well in 2022. I think that would have been difficult to predict before 2021. Going into 2022.
Yes, 2022.
And then we have another, it's essentially a fund that is market neutral, has no correlation to the market at all. And those both were up double digits for the year. And that's why they're in the portfolio. Because when everything else is going wrong, hopefully there's something that goes right. And that's not a guarantee, obviously, but again, that we own a bunch of things that hopefully offset each other when things are going poorly. And so if anybody out there has gotten caught up in growth in the past few years, or even now are doubling down on value, I'd say you still aren't going to go 100% value. You have to have a diversified portfolio. If we've learned anything from 2022, that is the answer that we got. And so looking forward, regardless of what happens this year, you still want to structure your portfolio to maximize the return as much as you can, given your situation in life and given your personal situation, your risk tolerance, all those things. But do it in a way that you're likely to have a successful outcome. So we're not just gambling. We're just not going to the casino and hoping to hit the big one. Right.
We're not trying to put a portfolio in position to beat the market. We're trying to work with the market to achieve the best rate of return possible, given the level of risk that anyone wants to take and is comfortable taking. And if you have that mindset of just trying to achieve the best return you can with a level of risk that you're comfortable with, I think your experience as an investor is going to be a lot better than if you're trying to anticipate which way the market's going to go, what's going to be the hot trend in 2023, and how can you make up for losses in 2022. I think getting out of that habit of trying to beat what the market is doing is a great way to start off the year on the right foot and focusing on how can we position our investments so that the market is helping us grow rather than being the inhibitor to our growth.
Right. Yeah. You want to swim upstream, not against the current.
Exactly.
And so, yeah, we'll leave it there. There's 2022 was a lot, and we could talk for a long time.
Oh yeah.
But hopefully those highlights are helpful to you all out there. And as always, any other questions, we're happy to answer. And we will see you all in the next video.
Thank you.